What's going on, penny boys and gals? What's going on, stock traders? And welcome to our PBU Live. We do this every Thursday, 2 p.m. Eastern with myself and Pookie's Revenge. How we doing, Pookie?
Hello.
Good
We're doing
to
good.
see you again. I know we had a fun time last night in our PBU graduation with a whole bunch of great new alumni. Congratulations to the Chag, who is currently here with us right now in the lounge chat, in the Discord, the voice chat. Chag was our student of the term, and Latvian, of course, was our valedictorian, the person who I want to see go one-on-one with you for trivia, Pookies. See who has the faster fingers.
All right, let's do it.
I'm not gonna lie, I got my money on you though.
Anytime. Anyway, no, just kidding.
Yes, but today we do have a lot of fun trivia in the past. But today we're actually doing a class about moving averages and RSIs. How they work separately, different settings that people can use, what the differences might be, different time frames, and all that, as well as how to use them together, and then also different strategies along with, the whole concept. So, Pookies, let's just dive right into it. Let's start with the moving averages. Let's pretend someone came right in here, has no idea what moving average even means. How would you describe it to somebody who's never been trading before? Like, how would you describe not only what a moving average is, but how a trader could use it to their advantage?
Well, first and foremost, I'd tell them that we cover this in the PBU, first off. So if they want a more structured education than just talking to me, that's a good place to start, but that's why we're here. So moving average is just an average that moves. I'm just kidding. So if you have supply and demand, any supply and demand, okay, think about it like selling baseball cards, okay? The card is worth what someone is willing to pay for it. Okay, so that means there's a transaction. Someone has money and they want the card, or in this case, shares. And someone else has the product, which is a share or the card, and they want money. So that is supply and demand in a nutshell. And a moving average is just a way to track those transactions over time. So if I pay $5 for a card and the next person pays $5.15, if we just took those two data points and we added them together and divided by the number of data points, which in that case is only 2, we'd get 5 and 15. I'm sorry, 5 and 5, 15. And the midpoint right there would be the moving average. Now, you want to do that over a longer period, obviously, to get more data, cancel out some of the noise, and just make it more useful by introducing maybe like 20 or 50 or 200 points of data. And all that does is it just says, the closing price within terms of the stock market. The closing prices are what is used to determine that average. So if I were to use the 20-period moving average, which you see here on my screen, and to add this, let's just start from scratch. So you go to your indicators, and this is Webull. If you're on TradingView or Thinkorswim, it's going to be slightly different. But on TradingView, if you don't have it here in the quick access bar, you can click indicators, and then it is a main chart indicator because it's right there on the price action. It's not a sub chart. It's not down here. And you're just going to go to MA. That's the simple moving average. There are other types of moving average, which we'll get into, but for the purposes of just keeping this simple, let me also hide all my drawings here because that's kind of complicating things. So if I want to change the length of this, in this case, you can see I have the 20 here. So if I increase that, you can see that the line gets flatter because there's less noise in the mix. And if I drop it down to 20 again and reduce that, it'll get a little more sensitive to price. It'll have a lot more noise in it, all the way down to 1. And what that's doing is it's just increasing or decreasing the number of data points, which, smooths out that average or makes it more and more janky. So in this case, the 20-period moving average just looks at the last 20 candles for each of these points on this line. It adds up the closing prices for all 20, and then it divides them by 20, and that becomes a plot on this moving average here. So as the price goes down over time, the moving average goes down as well. And over here, since these closing prices were going higher, 20 at a time, the moving average has a positive slope. It's going up. So that's how it's made. Now, how we can use it, there's 6 different ways you can use a moving average. And we cover that a little more in depth in the PBA, the advanced education. But one of the simplest ways is just to identify the trend direction. That's the easiest way to do it because the line either has a positive slope, a negative slope, or it's somewhat sideways, right? Like right here, it's kind of meh. It's hard to read. And SPY is not the best example here. So if we look at Netflix right here, this is flat, right? It's very compressed. The price action here isn't really going up or down very far. You can see there's these little abnormalities, but they're smoothed out by having 20 points of data incorporated. So these little abnormalities don't really count so much. However, when the price really starts to trudge down, it pulls the moving average down with it. So it's a following indicator. It follows the price. It doesn't predict the future. So that's the easiest way. And overall, you can see on Netflix, it's just a downward slope. It's a negative slope. So it's bearish price action or bearish bias, right? And that tells us that the easiest way to trade is just to look for bearish opportunities, such as engulfings or something similar to that, with minimal risk, and then just letting it go in the direction it wants to go. And if it reverses, we have a stop loss right there. Okay, so we don't have to worry about it. One of the other ways that we can use moving averages is if we stack them. So if I add a 20-period moving average, and then I add a 50-period moving average, that gives me two separate periods over which the price is measured, right? So 50, as we know, is going to be smoother because it incorporates more points of data. It's also measuring a longer period of time, so we can use the difference between these two lines to determine acceleration. Because if the most recent 20 candles are lower than the last 50 candles average, then that means that the separation here indicates that we're accelerating to the downside. So you can use the distance between these, as well as just their general position. That's the third way. And if you see the shorter one below the longer one, that just means that the overall direction is to the downside on a more recent time frame. Whereas if we go to the top side, where the 20 period is above the 50, that means that the bias is to the upside. And you can use, again, that distance between them as an acceleration, and that's more, it's basically how the MACD operates, which is another indicator. It uses the EMAs, but it's the same concept. You're just judging where they're positioned and how far away they are. And that tells you acceleration and trend strength. All right. So because, if I were to draw this, okay, just kind of going back to that baseball card. Well, let me go to a different chart because these are all cluttery. Let me just use 9. I like to draw on that one. So if this is supply and this is demand, right? So these guys up here have shares. They want money. These guys down here have money. They want shares. Okay. So these are the buyers. These are the sellers. This right here would be the moving average. This is the distribution mean. And this gap between supply and demand is the distribution zone. That's just where the transactions take place and the price kind of bounces around. And we affectionately refer to these zones as support and resistance. So top is resistance, bottom is support. Price bounces around until one of these breaks, right? So that's the easiest way to kind of judge that. But the moving averages themselves can also be used as support and resistance levels. They're dynamic, okay? Because it's the middle line. It's the scrimmage line of both sides battling it out. I'm going to get rid of this other one here, this 50. I don't really like that. That means that we can use these lines in a lot of cases as dynamic support and resistance levels. So you could see right here on 9, price broke down, pushed back up, and pushed right back down below that moving average. It couldn't break over it, so there's no participation up here because the bulls couldn't break it above that moving average. So they fought right here in this line right here inside this box, and the bulls won that case. Okay, it doesn't necessarily mean it's going to happen exactly. Sad trombone. It doesn't mean it's going to happen every single time. And again, we can use that to our advantage by using this as a stop loss. You can see it just repeatedly tests over and over and over again, and it just couldn't break to the upside. So the price went down and it pulled the moving average down with it. We now had a negative slope, and that's where the shorts are going to look for their entries. So let's go ahead and look back at SPY, because that is just really falling off. And that's kind of the core concept. Yes, $10 million. Nikki, I hope that's not you. All right. So anyway, yeah, and that's kind of the core concept behind the BAC strategy, or the big ass candle strategy, because we're using the moving average as a point of contention, and we're looking for the second criteria. So the first one is that you have to be near the moving average. Ideally on SPY, you're like within a 20-cent window. Above and below. And then you want to look for the second criteria, which is a sign of strength off of that level or away from that zone, because that's a decisive victory over that level of contention. So in this case, we got that by about 4 times. I typically like to look for about 30-cent moves on SPY, but this is over $1. It's a very strong sell-off, and that indicates that there's a lot of strength in that direction off the moving average when we see those 3 particular points converge into one. So that's one of the easiest strategies we have as well. And you can see today it would have worked out great. Other times, maybe not so much. It really depends on how intentful the price is and how decisive that victory was. So yeah, and you can see right now the price is very far away from the moving average too, which means this is abnormal. It's very far away from the expected participation at this point. So typically when you see stuff like that, when the buying comes in, it usually comes up to around that moving average. And then it tests that as a resistance level, similar to how it would if it was bouncing between key levels. Does that answer your question for now?
Yeah. And if anyone has any questions in the chat, that'd be awesome. As far as moving averages go, I know like a lot of people, when it comes to trending markets, they're a little bit on the easier side to use. How do you determine, all the crossovers? I know, everyone talks about the crossovers. How do you determine which ones might be valid versus invalid? Maybe possibly using other indicators such as the RSI or even just, possible other moving average timeframes.
Also, it depends, right? So one of the first things that we like to do when we add a moving average to a chart is to adjust it, right? Because you're not going to, the 20, 50, 200, those are all popular. The 5, 8, 13 EMA, those are all popular. But nothing is really going to be as effective as an adjusted moving average. So if I were to look at SPY, for example, on the 20 period, on the 5-minute chart, I'd want to adjust this either down or up so that it matches the price and tests it more frequently. Because I really care about where that price gets tested and how often it holds, because I'm relying on that probability. So in this case, if I move it to about a 31, just in this little window here that I'm using, we can see, even if I look back in time, that the moving average with a 31 setting seems to be pretty impactful. You can see here it bounced off of there, held right here, acted as a resistance right here, broke through, acted as a support, little contention zone there, acted as a resistance right there, right here, had a hard sell-off, support, and then obviously we failed that and everything fell down today, but that was good because we were playing the downside. So, just that simple act of adjusting a moving average can make life so much easier. So once I have this on the 5-minute, for example, I might kick it up to the 30-minute or the 1 hour, and just to double check, right? Because it's all relative to the time frame, and the 31 seems to hold pretty nicely here as well. So I'm going to go ahead and add a second moving average. And in this case, I'm just going to do the same thing, but I want it to test the more impactful levels. So maybe I'll kick it up a little bit more, and I really, really, really want to smooth out that price action. So right about here, you can see about 80-ish. Seems to be nice because it's touching right here. That was a pretty major pivot. We got this hard sell-off here. The lines are pretty close together. There's a lot of convergence there. So this was a good support level. Good support level here. Had that strong push off. Good strong resistance there. Resistance. Good strong support and a bounce here. Support, bounce. Like, it's just making those small adjustments when you add moving averages. And you can always just take notes. Like, this is the 31 and the 81 simple moving averages on the 1 hour time frame. So now all I would have to do is just look for areas where those occur, those crossovers. And then obviously you'd want to combine that with some sort of confirmation. So if I were to trade this on the 1 hour, the crossover happens right here. So after this point, then I would want to look for things like these engulfing bullish candles. So this right here, for example, has a very low risk. It's very easy to identify. You grab the entry on the break of this. You've got a stop loss right below the lower of the two and a 1 to 2 or 1 to 3 or whatever your ratio is for take profit. So that would have been pretty easy. This one here didn't break over this red candle, so that's not a bullish engulfing. And at this point, we're obviously selling off hard, so you wouldn't really want to just blindly jump into this for calls until it forms some sort of setup, right? So the first set here is to identify the overall trend, and then you want to look for some sort of setup, okay? And in this case, it would have been the cross up. Here we had the bullish engulfing, but now we've had this hard sell-off, so there's really no setup here for bulls. All right, even though we had a bullish cross up, it's probably going to come down here and either test this 50 moving average, or it's going to drag out sideways, and this 50 moving average will come up to it because the price is above the 50 MA. And you might find a better setup there, or it could just be abnormal price action and it could just blast because SPY likes to just disregard technical analysis. So for right now, you're kind of in between the moving averages. So you've got short-term acceleration to the upside, creating some distance between, the 31, I apologize, 31.81. So you had this spurt of short-term acceleration to the upside, but longer term, you're kind of going down and flat. So that's kind of why we're seeing a little pullback here, combined with catalyst, obviously. But the volume just determined it was coming down. So we just got to wait. That's all. And again, SPY is not something you want to trade on all the time.
Right. That is definitely true. I know you mentioned the different types of moving averages. Can you next explain what the different types of moving averages are and when to use each one? For I know every trader is different, and just like what situations might be different. Like what situation these smoothing techniques might be more appropriate than using the moving average.
Well, that was a bunch of questions there, bud. So it really depends, right? If you're more comfortable with a simple moving average, if you don't want a more reactive price indicator, then use the simple moving average. It's really good at what it does. It just adds up all the closing prices, and you get what you get, right? It's just a nice little distribution mean. You can use it to kind of identify when price is likely to come back to it, as well as the overall trend direction. So at the end of the day, that's all it does. It doesn't do your dishes for you. So then you can use crossovers and all the other 6 different ways to use them. They're all the same at the end of the day. They're all the same. They just tell you the same story in different ways. Okay. The next type is the exponential moving average, which is very similar to the moving average in the way that it operates, but it has an extra factor. It's got a weighted factor. And all that does is it just takes the most recent EMA value and it adds a little multiplier to it. And that kind of makes it a little bit more responsive to price. So if I were to use the 20 period EMA, and if I add the 20 period simple moving average, you could see that the EMA is a little bit more responsive. It's a little bit closer to the price because it's got that weighted factor. So I'd like to compare this to pretending to throw a ball for a dog. The dog is going to run either way. So when the price starts to move, the EMA is going to move. And sometimes that results in false signals and stuff like that. So it's important to combine that with some sort of price action oriented confirmation, like an engulfing candle or something like that. So the typical rule of thumb is EMAs are mostly used for the faster traders. So you can use like a 5, 8, 13 cross up, for example. So if I put those on, you'll see what I mean. So 5, 8, 13, and then I will turn the simple moving average off. And you can see that one of the simplest strategies is just waiting until the lines are stacked bullish, which is where you've got the shortest on top, middle in the middle, and the longest on the bottom. That's a bullish signal. And then you just ride it up with the bottom one here being the stop loss in most cases. And then when you get a cross down, that in theory is a bearish entry because it shows that the acceleration has stopped and reversed. So that's the easiest way to use those. But you can also use the longer EMAs specifically for the higher time frame. So if I use like the 120, for example, and then I kick it up to, let's say, the daily chart, you can see that we're still kind of hovering around it. But if you look historically here, the 120 EMA has been pretty good for SPY. And again, it's SPY, so it's kind of inconsistent. But you can see it's bounced off there nice and cleanly many, many times. So if you're looking for the longer trade options and stuff, you can use it obviously to see where the price is in relation to the moving average and then look for signals in that direction. You can look at the slope of the EMA. It's going to turn around a little bit faster than the shorter term ones, or I'm sorry, than the simple moving average because it's more responsive. But it really just depends on what your approach is. You can also combine the simple and exponential moving averages, but I don't see a purpose in that myself.
No, I like how you said that depends, on what you personally decide to use. I know Chag was asking in the chat, just about like different moving average periods to use together. I know Master's saying that he uses the 21 and 200. Gabe says the 8 and 13. I know you can ask, a bunch of, you can get 20 veteran traders in the room, and they'll probably tell you at least 10 different combinations. There's a bunch of like common ones, which is one is the 5 period and the 20 period is more of a short-term combination. This is the dual moving average crossover strategy using the 5 and 20. There's the 10 and 50, which is also commonly used for a more extended view. And then of course you have your 20 and 200, which is really, really commonly used, especially in long-term investing and trend following strategies. The 200 moving average is often seen as a critical level. So crossovers there usually are significant shifts in either bullish or bearish energy. Of course, depending on other factors, you have your 5-day, 20-day, and 50-day. If you want to use 3, provides another view of short-term movements with the 5-day moving average helping identify various short-term trends. Then, of course, you have, like you said before, you can use your EMAs with combining such as like the 10-day or your 10-period EMA and the 30-period EMA is a common one, as well as the 5, 10, and 20, which is the triple moving average crossover is what they call it. But I'm curious for you, Pookie, What do you personally use? I actually put in the free education, the moving average class. I believe Austin's moving average, what the periods that he uses is in there.
He was like 5, 8, 13,
Yeah, his is different.
55, 34, or something like that. You want to know a secret though?
What's that?
None of it means anything. So if you are looking for specific lengths to put onto your chart, that means that you're being anticipatory. That means that you're looking for specific signals based on the moving average rather than what the trend and the price action are telling you. And I only say that because if you want to, let's just put a random number in here, right? I'll just put in 45, right? 45 seems easy. Now, of course, we want to adjust it to the chart so that we can identify things more clearly. But if I'm just looking for, let's say I want to have a positive slope on the moving average, and I just want to see a bullish engulfing that has a great max risk of like 30 cents, okay? All I have to do is draw my little box around here. Well, it's gonna be weird on the higher time frame here, but let's kick it down to the 5 minute just for fun. All right. And if I'm just looking for engulfs off this moving average above it, well, it has a positive slope that fit inside this box, I'm gonna find it no matter what. So it really doesn't matter what specific length you use. There is a certain element of the Pygmalion effect, which is a self-fulfilling prophecy, and that's why certain ones are more popular. But it really doesn't matter at the end of the day what you use. It's how you use it. So again, it's more important to have the criteria around the indicator than the actual settings on the indicator itself.
The way I see it, it's like, me and my brother would play video games all the time back in the day, and he would have his sensitivity on his controller up like to like almost the max, whereas like meanwhile mine's like the complete opposite. So like but we still play just as good, when we play against each other, or whatever. But it's completely different settings, and so it's it's really what works best for you. And of course, just we know how to play the game. That's what matters. So it's knowing how to use the indicator, the moving average is really what really matters, and then you can just kind of find out which setting works best for you. But it's really knowing and actually how to use it. Like if you didn't know how to play the game, it doesn't matter what sensitivity you have it on. You're going to be running around in circles. So learn how to play the game and then figure out what settings work best for you.
That's the whole point of an indicator. It's to help you understand what the price action is doing. It's not some magic formula that you have to figure out specific configurations for and then you'll be successful. It's helping you interpret the price data in a way that you can trade with confidence and more importantly, just understanding where the max risk is. So if you want to use the 45 EMA and you want to take bullish engulfs like that, and you want to use the moving average as a stop loss, wait for the bullish engulf off the moving average and you have defined risk. And then you can trade that with confidence and it doesn't really matter, right? If you're using appropriate position sizes and all these things, come together in a way that prioritizes risk management. And as Matster said, you just pick one and stick with it. And then you calibrate yourself to the moving average and vice versa to an extent. You're going to have a much better time and more consistent results than if you download someone else's settings and then try to make it work.
Right. Exactly. We actually have a few more questions in the chat. Chag had one. Master actually did have another one. Asking about moving averages. Can you use it to keep you in a trade?
Absolutely.
That's a great question, Master.
Yeah. Obviously, you don't want to let that override common sense. Like here, if you're trading the higher highs, higher lows, and you see, this particular entry or something, it might take some time for the moving average to turn around. If you've got like a hard sell off like this, like on this candle right here, this still technically had a bullish slope. Right here, the price punched through it and it kind of went flat. So this is it's a very, very quick rollover on the moving average. But you can always use a moving average as a stop loss or keep your stop loss just on the other side of it, because in theory, if the trend's going to go, it's going to go, right? And if it's below the moving average, that means that they have failed that line of contention, and you can always just seek a better entry somewhere else. It doesn't have to be this particular area, and you don't have to catch every single trade that happens. But if the price is down here and you're hoping your buy from here comes back, you've already lost. You know what I mean? So at that point, you're not going to be relying on the moving average for that. Or if you're waiting for a cross down specifically, because they tend to take a little longer than just the single moving average. Because the slope has to change, then it has to cover that distance. So.
Right. I'm trying to see if there's any other questions. Anyone else have any questions on moving averages for now? And get another minute or two before we move on to RSIs. And then, of course, we'll bring it all together on possible strategies to use them both together.
Yeah.
Teed up question.
We had it ready.
Hey, we appreciate that, though, Master. We know we need those teed up questions every so often. Just questions in general are really good.
Yeah. Any question?
Yeah. Before we do move on, I just have one question here for you. How do outliers and extreme values, just big data set extremities affect the interpretation of moving averages? Like, does it, whether it's volatile versus trending markets, like how do you determine when, the moving average might be skewed based off of some type of extreme value or outlier?
Well, that's what we're saying right now in SPY.
Yeah.
Yeah. So if you look at the slope, right? If you just pay attention to the slope here, this moving average, it's pretty consistent. It's pretty flat. It's a 45 period moving average. And then we get this massive sell off. Now, this range right here is much bigger than anything that's happened all along this entire pathway here, right? But you can see that the slope, the angle of the slope here, is relatively similar to what it was before, right? I don't have a measuring tool, but that looks about equal, right? Despite this drastic difference in price. And that's what the purpose of the advantage, the average is, right? In this case, you're looking at 20 candles here, 20 candles here, and you're looking at the closing prices. You're adding them up per plot and then dividing by 20, and then that becomes the value. So when you're looking at this candle right here, for example, this guy, and we look back 20 periods, incorporating all these candles. Let me just get rid of these extra boxes here, right? Because as this is forming, this is what you're going to see. It's right there. Okay. So this is the outlier at that point, because this is nice and tight. It's a little choppy, but it's nice and tight considering, right? It's not that far away from the moving average. And then you start plummeting right here, and that introduces negative slope. So we just have to be careful and kind of use our brains when it comes to these outliers, because they do count as one of the periods in the length of periods. So if you have a moving average that's like, I don't know, 5, right? If we just put 5 on, that outlier is going to count for more. Because now if you're looking at this candle, for example, and you look back at the last 5 candles, you're going to be right here. Oops. So that then becomes your data set for this plot point. I'm sorry, this plot point up here. So it's the number of lengths divided by that outlier's impact. So the more periods you include, the less those outliers count, and the fewer periods, the more it counts. Similar to the Bollinger Bands.
Yes, I know it says here that one way to do that is just like you kind of said, you're just replacing the extreme values. So you're just getting rid of them. If there is a huge, big value, maybe at the end of that trend, or in the beginning, I guess, of the trend, you could just take it out and just use, like, let's just say it's like, 7 days ago or whatever, 7 periods ago, you had that big outlier. You could just say, all right, I'll just look at the six period moving average then.
Right. Yeah. Absolutely. And that's kind of the advantage of being able to change these settings, and especially with like TradingView, Thinkorswim, you can back test. You can replay the price action up to that point and see, what happened, like how much of an impact that specific candle had on that data set with that settings. And if you're a nerd, you can build a spreadsheet out and you can see exactly how much deviation it has, or you could just subtract this MA value from this MA value. In this case, it's 15 cents. So I know that this candle right here has 15 cents worth of impact on that moving average with a 20 period setting. Whereas this one, which is less of a jump there. I'm sorry, it was this one. That's 13 cents, right? It's less aggressive of a move. This one here is, that's math. That's 11 cents. So you can see that the impact these candles have gets smaller the further back we go in time. We're getting closer to where this consolidation is. And these guys count for less of the ratio when we start to include these guys. So as we shift over here, it becomes mostly these small candles and a couple of these big candles. So hope that answered that question.
It definitely did. We are at the halfway point, so I think this is the perfect time to move on to RSI. So we're going to hop on down to that sub chart.
All right.
So I guess let's just start with the basics. Just what is the basic concept of the relative strength index, RSI, and why is it considered such an important indicator in technical analysis?
Well, I'm glad you asked, Timmy. So the RSI is a slightly different formula, right? It's a bound, meaning that it can't go below 0 or over 100. It's a momentum oscillator, and it shows a ratio. Okay, so all it does is, in this case, the default setting is 14. So all it's going to do is it's going to look at the the most recent 14 candles, I like the movie 16 Candles. So it's going to look from here all the way down to here. Okay. It's going to take all the green candles and add those up. And then it's going to take all the red candles, the size that each candle covers, and it's going to add those up. And then it's going to convert those into a ratio. All right. Right about there. Okay. So this would be the net positive gains, and this would be the net losses for that look back period, the 14 candles that are in the past. And it's just going to convert those to a ratio and then plot it here on a chart from 0 to 100. So when the losses, so in this case, if we added up all these, right, just candle to candle, okay, and then we add like this candle, and this candle, okay, if we just put those end to end, that would count for the numerator here. And then if we add up all the red candles end to end and put those in the denominator, we'd get a value from 0 to 100. Does that make sense?
Yes.
Okay. So then we can use the differences in that value over time to identify things like change in trend strength, because that's all we're looking at. We're seeing, you know, this look back period for this candle or for this plot point, right? When this big white bar was introduced. So if we just boop right there, you can see the RSI increased because this introduced more positive candle action than the last 14 candles, because this includes that one, and the rest are in the denominator. So it's very oversold at that point because it's just a lot of red. It pushed down really fast. So when we see this big surge of green or bullish price action pop in, and we add this guy on top of it, that changes the numerator, changes the ratio, so we move up. I love it. I love it. So with that said, there's extremes and there's kind of a mid-range. So obviously, if we have an equal balance of green candles and red candles, right? If we added them all up, the 7 candles were exactly the same size on both sides, we'd have an RSI of 50. It'd be right in the middle. Okay. So when we get an imbalance of, let's say profitable candles, maybe one candle's bigger on the profit side, the RSI will go above 50. If the loss candle was a little bit bigger and all the rest of the green ones were the same, we'd go below the 50. All right. Because it's disrupting that ratio. So if we look at the RSI over time and we see that a value drops below 30 or below 20 even, that's very oversold, we can say that there's a disproportionate amount of sell-off and it's overextended in the selling direction or the bearish direction, okay? That identifies potential opportunity, but still strength because it's still pushing down really, really aggressively, but it presents opportunity for the bulls to recoup some of that and bring it back to that 50 RSI. So in this case, if we were to be little cheaters about it, we could just really focus on where the RSI crosses back up over the oversold line. And in this case, would have been that. You combine that with a engulfing strategy, and you got your little bounce, right? So the overall setup is the hard sell-off, 25% bounce that we see 90% of the time. And this is where it's important not to just focus on the indicator, but you got to identify the setup. We know that this was going to hit 90% of the time. This is our indicator confirming it, or presenting the opportunity, I should say. And the engulf candle right here introduces the opportunity, or maybe you catch the second one, whatever it was. But we also know exactly where the defined target is. And entry right there, defined stop loss. And you can put obviously you can put your take profit like at a 1-to-2 ratio. So like right here for the safer trade. But we could understand that we have the opportunity here for this trade because we're overextended. Right? You had another opportunity right here. Let me just erase all these. Okay. And this is where it's important to have that defined risk, because at one point, this candle was solid bullish, right? Which means it did break over this guy. And the stop loss would be 1 cent below the lower of the 2, and then a 1-to-2 ratio. So that would have been the trade. It just would have stopped out, right? You still had the overall setup here was a strong impulse to the downside. You were still in overextended territory. And you curled back up. So the opportunity was there. We didn't quite cross over the 30. So that was a red flag, but we had an opportunity here for a trade. We had defined risk and defined profit, and it simply didn't work out. Whereas here, it did, right? Same exact setup. It's just this is a little more overextended, but it's the same setup. And that's why it's important to be consistent, because you're going to have winners, you're going to have losers. But if you took this one loss and the loss was that big, and you took the win and that win was this big, you combine those, well, that way, I guess. That's your own little personal RSI, and that's your trend strength indicator for your profits. So that's what we want. That's why we wait and we're patient. Does that make sense? I didn't get into divergence or all that stuff.
Yeah, I want to get into divergence next. But before that, are there any just like specific market conditions or even just types of assets where RSI tends to be more effective or even less effective? Because I know everyone loves RSI strategy, but it might be good to know which areas you might not want to use it or do want to use it.
Yeah, for sure. So CHOP, right? Every indicator that deals with momentum, trend strength, trend direction, that struggles really, really hard when it comes to choppy conditions. And CHOP just means, maybe it's heavily consolidated, but for the most part, like this right here is CHOP. Okay, if we look at it horizontally, okay, it's just kind of bouncing back and forth. And you can see the RSI is just kind of flat during this area here. Here you had a little aggressive push up and then it fell back. So right around here, you can see that the RSI just kind of stayed in the range, right? So if I draw the 50 RSI, you can see for the most part, the RSI hung out above the 50, which means you did have more bullish participation, and it did kind of go up over time, but it didn't really have any clean moves from, how the RSI is concerned anyway. Obviously, we had higher highs and higher lows and all that good stuff, but there's really no clean direction here. Whereas if we go back here, you can see that the RSI spends a pretty good amount of time above the RSI, the 50 RSI, even pushing into overextended territory, but the price action is much cleaner. So this is the kind of condition that we like to catch those little pullbacks on. There's one too. So this is really what we prefer, not so much these choppy conditions, because you can see the RSI is kind of up, down, up, down, up, down. Whereas here, it's just kind of up and then it hangs out, right? And that just means that there's continually new bullish candles put into the mix. Yes. This is nice though. I like this. This is nice. So
you got a little divergence going on.
Yeah, let's look at that.
Let's talk about that.
All right. This is a really bad chart to do it on, but here we are. So divergence has many forms, right? One of the easiest ones to identify is bullish divergence. And all you do for bullish divergence is look at the lows of the price action and the lows of the momentum oscillator, which in this case is the RSI. Now, there's all kinds of momentum oscillators. You got your stochastics, your MACD, KDJ. All those are momentum oscillators, which just mean that with changes in momentum, they change direction. Okay, they go up and down to indicate changes of acceleration. All right. So in this case, if we were to look at the lows here, here, and here, we can see they're relatively flat. But here, we've got descending lows. Okay, so when they're flat, that's essentially the same as going up. In this case, up or down, it's kind of a wild card. But you can see that ultimately what matters is we have a difference in slope. Okay, so this is a clean down slope. It's clearly pushing down. This is flat or just not this, which means we have a difference, and that means we have divergence. Okay, so divergence is just when two of something or more separate. Convergence is when they come together. Divergence is when they separate. So in this case, the slope or the likeness of slope between this and the momentum oscillator are different. They're pulling apart. So if we draw this flat line here just to illustrate that, say this is the RSI's slope between lows, and this is the price action slope between lows, you can see that they are separating. Right? It doesn't really matter where they are. It's just you're just connecting that and the RSI the same thing over the same period of time. Does that make sense? At least how to identify it. Okay. So what this shows us is that despite the fact that the price is pushing down, it's still not gaining strength to the downside. In fact, it's losing strength to the downside. And that means that the trend strength is shifting from bearish to bullish, which is not a guarantee of a reversal, but it is an opportunity. And that is something that we can use. So if we just look for opportunities with divergence, you can tell one of the easiest strategies is wait till the RSI crosses back over 50, which it did right here. That would be the entry opportunity, right? As long as the candles confirm it and all that good stuff. So you'd probably skip that and you'd probably go for something like this because look at how tiny that risk is. I like it. But this is kind of the signal that it's shifted from bearish to bullish. So if you're someone who trades reversals, that RSI crossing back over 50 out of divergence is the kind of it's on signal, right? And then all you got to do is look for a nice tiny confirmation with super tiny defined risk. And you can get trends like this all the time. Sometimes you'll get chop and stuff like that. But that's the advantage of being patient. So this right here is another form of divergence right there, because if I take this slope, oh my, where did it go? Oh, Weeble, you're crazy. Maybe I can drag this one down. Nope. Okay, we're just not doing it today. All right. But either way, you can see that these lows are increasing. They're going up. It's an uptrend, right? So we can still look at the lows. Typically for an uptrend, you want to look at the highs to see when it's likely to turn over. But we can see here, this is higher lows on the price action, lower highs on the momentum oscillator, which means that despite the price going up, the strength is cooling down, which is an opportunity for bulls to continue. They're just cooling off. It's an exhaustion period, or it's an opportunity for bears to step in and reverse the price action. So as long as we hold these higher lows, we're good. In this case, we did. So this is a different type of divergence, and this is for continuation. So you've got reversal divergence, and then you've got continuation divergence, and that's classic versus hidden divergence. For bearish divergence, you want to look at the tops. You want to look at the highs. So let's see if we got anything good here. We don't have it here because this is a higher high right here, and this is a higher high on the momentum oscillator. So that is not divergence for a reversal. This is obviously not divergence for a reversal. Let's see if we can find a good one here. I'm just gonna kind of cherry pick one here. I'm just gonna look at divergences that occur across the tops here. So let me go ahead and just skim right here. Okay. So in this case, we've got a lower high, and then right here we've got a higher high. All right. So if you're looking for a bearish position and you're paying attention to the tops of the price action and the tops of the momentum oscillator, you can see that the next time this pushes down, that's probably going to be a good push to the downside because it indicates that the bulls have lost strength and the bears are stepping in and forming lower highs, right? So they're increasing strength and decreasing price action. Here's another example right here. All right, so we've got that, and then we have a negative slope on the momentum oscillator. So this is a cool down period, right? So in this case, the opportunity for bears to step in was there, but they failed. They didn't capitalize on it, so the price just kept going. So this divergence became invalidated, and we could have just skipped over that because the RSI never cleared below 50. That's kind of the confirmation, quote unquote, is right there. So in this case, the RSI didn't break below 50 before we got a higher high on the oscillator. So this divergence was invalidated. So that wouldn't have been a bearish trade. Similar to this, right? It forms a lower high right here. So that's invalid. You can't use the RSI 50. The price never broke over it. Okay, so hopefully that makes sense. It's just a strength direction indicator. It's saying it's going this far with this much strength in that direction. And then you can see if the direction is gaining or losing strength. All right, Master, have a good one, man.
Yeah, take care, Master. Yeah, we're at the 45-minute mark, so we're going to actually be moving on. Unless anyone has any other questions to RSI, we're going to be just moving on to just combining what we just learned with the RSI and the moving average. I know a lot of people use one indicator to determine that a possible trend reversal might happen, then they use another indicator to actually confirm that. So I'm curious, how could traders use the RSI and the moving average? Of course, one, to determine possible, either divergence or possible reversal, possible trends, and then using the other to confirm that and possibly enter a trade using that.
Yeah, so I mean, at the root level, right? Everyone focuses on the 70 and 30 or the 80 and the 20 for the RSI. Really, all you have to focus on is the 50. That's at its root what it's for. The way it was intended to be used was to say, okay, there's more bullish action in the candles, or there's more bearish action in the candles, and that was based on whether or not it was above or below the 50. So one of the easiest ways to do this is to look and see where the RSI is. If it's below 50, you typically want to look for bearish signals. And in this case, if you're using the MA to confirm that, you can literally just short or buy a put on a candle that is below the moving average and use that moving average as a stop loss. So in this case, that would have worked beautifully, right? As you can see, and right here, for example, this candle, you want to look for kind of the full first candle that pokes over the moving average because you're going to want to use that moving average as a stop loss. So in this case, the RSI is above 50 here, all the way over to here, minus this little dip right here. Okay, which in that point you would have just hit the stop loss. So I'll just erase that. But if you really want to make trading simple, if you just look for the RSI being over 50, you can just grab that candle. First full candle over the 50 period moving average. You go up, you come down, you go up, you come down. Your stop loss is right here below that candle. You don't really get filled. Maybe you got filled here. Maybe you didn't. Let's see what the low is. 82, 82. So maybe you did, maybe you didn't, right? You always want to go 1 cent below the low. In that case, you wouldn't have gotten filled. That's an easy trade all the way up until the RSI failed to hold the 50 level, right? Or, you could have used either of these guys. Same thing. You would have probably stopped out right here because it dipped below, and that's okay, right? The goal is to have defined risk and then let the profits breathe as appropriate. RSI is over 50 here. That's an easy entry. That's an easy entry. That's an easy entry. And you're just setting your stop losses right below each of those candles. Or you can use the moving average itself if you want that defined risk. And what's more important is that you scale out responsibly. And that's literally as complicated as trading ever needs to be. Here we got the RSI over 50 right here. And we got a bullish candle on its own formed right there. Again, it's a very easy way to trade just using these two indicators without necessarily needing to be a master trader. It's all about how you stop out. It's not, finding the perfect entry all the time and making every single entry count. It's how gracefully you can manage your risk and how appropriate your position sizes are. So that's one way you can use these two. You can also use crossovers and things like that. But ultimately, I personally prefer to use the RSI the way it was intended, and that's just to determine which side has favor or which side has bias based on, is it above 50 or below 50? How far? Is it below 50 and below 30? At that point, that's subject for a bounce. Sorry if you guys can hear my gross washing machine in the background.
Oh, that's what that was.
Yeah. Yeah.
Thought you're at a YMCA or something.
Just eats my clothes.
Does anyone in the chat have any questions? I see Snowflake typing. We got some brand new alumni in the voice chat here. We got Chag. I see Roto in there, Latvian, who is our valedictorian, won a Penny Boys mug. Eat, sleep, trade.
The one you almost smashed on stream.
What? No, I dropped. Yeah, I almost dropped that. Yeah. That's funny though.
Well, would you look at this? You guys see this? RSI is over 50. Candle, stop loss. Like it's not too hard, guys. We don't need to complicate trading any more than it already is. The RSI is over 50. We got some candles here. We got some candles there. Here, the RSI is below 50. We got a candle here. We got all these candles here. We got a candle here. Obviously it's oversold here, so maybe we can just wait for the price to break or the RSI to break over 30. At which point you got an entry there. I mean, it's pretty easy when you think about it like this, guys. RSI is under 50 right here, so let's look for some red candles. There's your stop loss, and you could have caught the whole thing if you're crazy. But RSI is over 50 here. This is on the 1 minute time frame. So if you guys are looking for a very simple strategy, that's it. I mean, I know a lot of guys try to trade SPY and they struggle and try to do all these complicated things, but it really, really can be simple. You just have to understand what the indicators are showing you and how you can use them yourself with confidence. So don't just blindly copy other traders and steal their settings because it won't do you any good.
No, yeah, definitely. Playing follow the leader works as long as you have that leader there. But people, that's not typically how it always works. That's why we don't like to teach the follow the leader mentality. We're more so about just teaching how to, trade your own plan.
Yeah, you guys can copy me all you want, but what if I get hit by a bus? How are you going to manage that position?
Yeah, I mean, it happens. So that's funny. You just said, not funny, but
wow.
As we were in the stream, I got a text that I'm taking like dance lessons with my girlfriend. I just got a text that the dance instructor got hit by a car. She's okay. We won't be making it tonight though. So yeah, anything can happen. So don't play follow the leader because Pookie was
leading out in the traffic.
In jest, but obviously we don't want that to happen to Pookie. But to protect Pookies at all costs, like Agent Penguin says. So Sentinel Black is talking about our PBU course. He's glad that he decided to wait till next round to take the test. He didn't want to have to compete with our current or new valedictorian Latvian 95. Latvian's happy to pass the torch off to you.
Latvian's insane, man.
Yeah, Duco was our first one 2 terms ago. Now we have Latvian, and I'm curious to see who the next valedictorian is. We actually have our new course coming up Starting next week is going to be the start of our week 1 of our 8-week course, going over all things trading psychology, trading plan, charting, candle patterns, as well as fundamental analysis such as SEC filings, insider trading, the whole 9 yards. And then in week 5, we even go over alternative finance such as futures trading, commodity trading, forex, real estate. Even we even go over entrepreneurship and AI, the whole 9 yards. But the really fun thing is that we actually, for this term only, we have a fun charting masterclass with BTCJ. BTCJ is our technical analysis wizard. That's pretty much all he does. He just eats, sleeps, and breathes charts. He just practices charts in his spare time. Like
charts?
Yeah, all about the charting.
Okay.
And so we have an 8-week master course. That's going to be a live master course every Thursday, 5 p.m. Eastern. Actually, today it's not going to be the start of it. Next week is the start of it. Week 1 is going to be the 19th of October, and we're going to be doing basically every Thursday. We're going to be doing a new topic on charting, going over all things from our 8-week course that we have. Week 3 is our charting week. We go over all things from that week in this masterclass. Is definitely worth checking out. I know that there's a lot of things going on in week 3. We go over support and resistance. We go over trend lines. We go over all that, like Fibonacci, everything. And there's a lot to cram into 1 week. That's why we're doing this 8-week master course, kind of spread it out and let y'all really get a deep dive into like how all the charting stuff works. Speaking of just new stuff that we have going on, we also have a stock buster. I don't know if you saw in the announcement section. We have a new live trader. I'm really excited to see him. He'll be doing Power Hour Thursday, 3 p.m. Eastern live trading, as well as 1:30 p.m. Eastern on Friday. He'll be doing some live trading as well. It'll be in the free live stream area available to everyone. I'm really excited to get him in here. He's a longtime trader. He's on TikTok all over the place. He's a really knowledgeable, really knowledgeable trader. So it's going to be nice to get a new perspective, especially during the afternoon, some live trading going on. So cool. I'm really excited for that. So a lot of new stuff going on. Make sure if you haven't already to check out the PBU area. That's where you're going to be able to find the charting master classes. We're going to be able to find all the new PBU courses. They'll be coming out starting next week. Next Wednesday is the first course. If you are new to the Discord, definitely make sure to check out our Rags to Riches and Smash or Pass sections. These are new sections. Rags to Riches, I'll let Poohies explain. But Smash or Pass is Austin's stream. He does this every Monday, 5 p.m. Eastern. Is going over a whole bunch of different trades for the week, and you have a whole section in there where you can ask questions to Austin. There's a whole breakdown of all the different trades that he talks about in those streams, and Porterhouse updates them as well with entries, targets, the whole 9 yards. So definitely be sure to check that out. And Rags to Riches, I'll let you explain that one. That's yours.
So it's a separate series. It's like a personal project. I just wanted to share it with everyone here in PB because, a lot of people just focus on speculative trades and finding strategies and stuff like that. And that is not sustainable long term because you don't have a plan for those profits, which means that you're probably just re-exposing them to risk over and over and over again. And that's kind of the only way that you can make money doing that. And B, it's just not good for you because it results in you probably having to spend a lot of time in the market. And in that case, you might make enough to offset your income, but then you're just trading one job for another, and it kind of sucks. It defeats the purpose, right? So the Rags to Riches is an account follow-along series, and I don't want people copying me and all that good stuff. It's to illustrate how you can take a safer, more passive income-oriented approach. And I know people, it's like, oh, it's slow, it sucks, blah, blah, blah. It really doesn't, especially if you're losing money month over month. Because it forces you to trade on smaller amounts anyway. And what that does is it takes the bulk of your capital and it saves it so that you're not necessarily throwing it at SPY or anything like that. So it's a very specific strategy where you take 70%, put it in dividends, and then you can still trade actively with 30% of the portfolio, and that limits your losses. So while you're still figuring it out, while you're still trying to figure out how to trade and all that good stuff. And I talk about the tax advantages and how to avoid, losing that money for good. Because with this approach, I don't care if I take a loss. I get it back at the end of the year. I put it right back in my portfolio. I just keep shoving it through the same machine until it turns into a win. Then I take that win and I reinvest it. So every single dollar that I have, I'm just doing that. So because I know about things like the wash sale rule and my max capital loss claiming deductions and stuff and the indefinite carry forward and all that stuff. So on that series, I kind of explain more of a portfolio management approach. And there's still some descriptions, like the last episode I put out was on the strategy about the higher highs, higher lows, engulfing candles and all that good stuff with defined take profit ratios and all that good stuff. But If you don't have that bigger picture plan, you're probably going to not make it long term. And that's a difficult conversation to have. But if you can take your profits and convert them into passive income and make consistent contributions to your portfolio and really treat it like a savings account where you control the interest rate, you're going to have a much better and less stressful time in the market. And that's why I started that series, because I realized that we haven't really been focusing on that as much. And, I don't want to see anybody get burned by, just trying to speculative trade to make it, because that's painful. So, Latvian Netflix did nice though. That's where this profit came from. I took one small option trade. This is the account that I do the rags to riches on as well. And I just traded one option trade on it. And it paid pretty nicely. Go ahead.
So really quick, just to answer Gabe's question, it is actually a lot different than dollar cost averaging. Dollar cost averaging is like what people do with Bitcoin, where they just put X amount of money in every month or every week. Basically, every week I'm going to put $10 into Bitcoin, or every month I'm going to put $100 into Bitcoin, no matter what the price is. That's what dollar cost averaging, and this is completely different.
Yeah, I mean, there is an aspect of reinvesting and adding to positions, but it's not so much the same as DCA. Like DCA is more so for long-term growth and stuff, and it does apply to a lot of drip components. But for this series, I want to manually control my positions, so I'm not having automated drip. Webull doesn't offer that, but I'd rather just be able to pick and choose which positions I add to. And this morning, I actually wrote in the breakdowns channel what my end goal is for this account. It's an average of 10 positions that have a compound annual growth rate of 12.19% over 10, 30-year period. That's beyond the 5 years challenge part of it. So within the first 5 years, I'm going to manually manage all those positions and not restrict myself to those slower but more stable positions. So yes and no, I guess is the right answer. But the cool part is it's all 100% free. It's on YouTube. It's here in the Discord. You guys don't have to do anything extra other than watch it. So if you're curious or just looking to supplement your trading plan, it's there. Like it's not something you have to buy. It's not something you have to fill out forms for. You just go to YouTube and watch it. Make sure you obviously subscribe so that you get the notifications, but that's it. I just show you how I'm going to do it on this account. Started at $500 last month. We added some to it, contributions, and we're here. I took a loss on SPY the first month. Not going to enter that again for another 30 days.
I like Gabe. That's funny. Yeah, it definitely isn't sexy trading or smexy trading, as you said. No, I know that's like options day trading and leverage trading and all that, but this is definitely the safer, longer term type of.
I'm still doing it. Trust me, I'm still doing it. But the difference is when I do it and it works against me, I'm not destroying my portfolio because I'm doing it on smaller positions. So I'm absolutely still doing like 5-day trades a day.
You know what is smexy though, Gabe, is 5 p.m. Eastern. Myself and BTCJ are doing our PBU live. We're actually going to be doing this one in the free live stream area. I'll be doing this special for you so everyone can join. We're going to be doing a live charting, and basically what that means is Bitcoin J is going to be our educator during the 8-week charting masterclass. So basically, live charting means that you come in with your charts. By charts, I mean tickers, and BCGJ is going to go to town. Just set up some support, some resistance, some trend lines, and some possible entries or exits, both bearish and bullish. So come prepared with different stocks. Maybe it's Netflix, maybe it's Nvidia, whatever it may be. There's different stocks and tickers that you want BTCJ to go to work with as far as the charts go, and then we'll of course be getting right into. Yeah, he's brilliant. And then we'll be getting really into the how he does all that stuff during that 8-week course. So definitely be sure to check that out. I'm going to go ahead and end the recording, Pookies. We're at that 1 hour mark for those who are watching after the fact. We can stick around the Discord if you want. But we appreciate everyone for tuning in after the fact. And also for those of you who are live, we hope to see you next time. But until then, we hope that you all make some bread.
Bye.